Today we are digging into something that, on the surface, sounds incredibly boring: commercial insurance. But it actually looks like a glitch in the matrix. We've been poring over the data on Skyward Specialty Insurance Group, ticker SKWD, and really the big question from our research is this: is the market just asleep at the wheel?
It really looks that way. The market is pricing Skyward like a standard cyclical insurer.
So they've peaked, the party's over, that kind of thing.
Exactly. But when we dug into the numbers, we found something totally different. We believe this is actually a structural compounder that is, effectively on sale.
So the market sees a value trap, something that's cheap for a reason. But our thesis is that the business model itself has basically mutated.
It's mutated into something much better, yeah.
Yeah.
They've pivoted to what we're calling a carrier plus model. It's a hybrid. And look, the key to all of this is their recent acquisition of a company called Apollo.
Let's unpack that, because usually when an insurer buys another firm, it's just to get bigger. Why is this one special?
It's the math. It really comes down to the math. Skyward bought Apollo for less than 9 at EBITDA.
Okay.
In the insurance fee business, you usually pay 12, maybe 15 times for those kinds of assets. So right away, you see they bought $1 of earnings for like 90 cents.
All right, so they got a great deal. But how does that change the fundamental business?
It changes the plumbing. See, a traditional insurer has to hold a ton of its own money in reserve to pay claims.
Right.
But Apollo is different. We found that 73% of its premiums are backed by third-party capital.
So wait, Skyward wrote the policy, they manage the risk, but someone else is putting up the cash to back it.
Precisely. Skyward earns a fee for their expertise, but they don't have to bloat their balance sheet with the actual liability. We call it the infinite ROE concept.
Capital light.
Very capital light. It creates steady cash flow, and it dampens that volatility that scares investors away from insurance stocks.
That sounds great for the accountants, but let's talk about what they're actually insuring. I saw something in our notes about I bought insuring businesses of tomorrow. I mean, are we talking about sci-fi stuff here?
We are. This is one of their wildest competitive advantages. They're underwriting robotics, autonomous delivery bots, even crypto risks.
But how do you price insurance for a delivery robot? There are no actuarial tables for that. We don't have 50 years of crash data on this stuff.
And that lack of data is the opportunity. Because Skyward is willing to be first, they are building the data set themselves. They get what we call the incumbency advantage.
So they're writing the rule book as they go.
Exactly. By the time a giant like AIG figures out how to price a self-driving pizza bot, Skyward will already have years of its own proprietary data.
Okay, so they do the future stuff, but looking at the rest of the portfolio, they seem, I don't know, surprisingly picky.
We call it the sniper approach. They have these really specialized divisions, especially in what's called transactional E&S, excess, and surplus lines.
And they target really small accounts, right? Average premiums of about $30,000.
Yeah, which sounds tiny for corporate insurance.
Why bother?
Because the giants ignore it. It's too much friction for them. But Skyward uses technology to quote these deals incredibly fast. Their moat here is pure speed. A wholesaler calls them first because they know they'll get an answer today, not next week.
You mentioned technology. I have to be the skeptic here. Every company says they have AI now. Is Skyward's SkyDrive platform actually doing anything, or is it just a marketing deck?
No, it's actually legit. We look really closely at this. The biggest bottleneck in insurance is unstructured data. Messy PDFs, spreadsheets from brokers.
Total mess.
And SkyDrive automates the ingestion of all that. It's not about a chatbot. It's about real operational leverage. It lets the human underwriters actually think about risk instead of just doing data entry.
Okay, let's verify this with the financials. Does the scoreboard actually match the story?
The growth is, it's startling. We reviewed the Q3 2025 data. Revenue is up over 50%. You compare that to a market darling like Kinsale, which grew about 8%.
But fast growth in insurance can be a huge red flag. Are they just underpricing everyone to get customers on the books?
That was my first fear too, but the combined ratio says no. That's the key metric, right? Money out versus money in.
Anything under 100 is profitable.
Right. And anything under 90% is just world-class. Skyward came in at 89.2%.
So they're growing 50% year over year, and they're doing it with elite profit margins.
And yet, and here's the disconnect, our valuation models show them trading at about 14 times earnings, or 2.5 times book value.
And their peer group?
Their peers are at nearly 7 times book.
Wow, that is a massive gap. So what's the catch? I did see some insider selling in the report. is management dumping stock.
Good catch, but we checked the filings. It's almost all F taxes. Basically, when their shares vest, they have to sell some to pay the IRS. It's not a lack of conviction.
Okay, so let's wrap this up. What's the takeaway for you, for the listener?
I mean, the big picture is this. Skyward has transitioned from a boring, old-school balance sheet insurer into a tech-enabled global risk platform. But the market is still pricing it like the old version.
It's a classic mismatch. Perception just hasn't caught up to reality.
And that leaves us with a final thought. If Skyward keeps putting up these Carrier Plus numbers, how long before the smart money realizes this isn't a value trap, but a breakout star? That window won't stay open forever.
Something to chew on. Definitely take a look at the charts. Thanks for listening to this deep dive.